Paul Notle is a senior vice president and portfolio manager at Kingview Asset Management. Paul, a little bit of weakness for stocks this morning. Lots to chew on earnings. We're going to hear from the head of the Fed a little bit later on. What are you watching?
We're really watching the Fed. We're to a lesser extent watching earnings, but those are going to be more company specific. The Fed, I think, is really going to be driving the market over the next 3 to 6 months or so. Chair Powell said last week the economy looks great, and the markets, I think, are anticipating 2 more hikes. And that gets us a lot closer, if not, to an inverted yield curve, which has been widely reported as a precursor to the next recession.
Yeah.
So we've got a lot of things going on when we take a look at the Fed activity.
We were talking with Andrew McCreath about this earlier, and he was saying, listen to Powell on 2 fronts. If he starts talking about maybe some concerns in global markets, maybe in some of the emerging markets, that might be code for he's not sure that he can continue as aggressively with this rate hike plan. If he talks a little bit more about how there's wage growth, maybe sort of speaks a little bit more to some of the inflation indicators, that might suggest that he is sticking with this plan to raise rates. Would you be looking for some similar language?
We would. You know, he's really downplayed the international bend, if you will, and has really, in a lot of his comments, focused primarily on the U.S. markets. He hasn't really said too terribly much about the emerging markets, and he's really taken a pass on a lot of the trade tariffs and the trade talk. So I think his focus really has been on the U.S., and I think that will be, certainly that's one of the things that we'll be listening for. We'd be surprised if he references much and comments heavily on trade or the emerging markets.
All right. While you are looking more at what we hear from Jerome Powell, and we'll have coverage on our website, bnnbloomberg.ca today, of those comments, it's hard to ignore this Netflix shortfall in their quarterly results. Tech has been the best performing group so far this year. Is this a game changer in terms of the sentiment?
I don't know if this one particularly is a game changer, but I think it certainly points up the risks of the technology sector when you do see a miss. And when you take a look at a sector that has been as hot as the technology has been over really the last 3-4 years, when you see some of these pop up, it starts to give you a little bit of a reason to pause. Technology historically has been one of the last market movers if and when the markets do turn down. So this may be, again, an early sign, but I think it's really way too early to say the technology sector is dead. We'd be looking more from the staples and utilities to pick up to confirm that. Well,
I think when you were with us in early June and we saw the NASDAQ getting to that record high, you said some of these companies were still relatively cheap. I guess I wonder, we did an interview with Tuna Amobi of CFRA Research earlier, and he said it's getting harder to justify being bullish on Netflix because the stock has rallied so much, because the valuation has grown so much.
No, that's true. And in the case of Netflix and Amazon, both of them have had huge runs this year. If you look at some of the other parts of the technology market, and really one of the things to take a look at is some of the mid to smaller cap names. So if you look at, say, an equal weight ETF versus a cap weighted ETF on the technology side, the equal weight is actually done as well or better. So really, I think the better values and some of the better opportunities are a little bit down the food chain, if you will, in the technology sector. So again, still one that we generally like, but have been paring back as the markets have run here so far this year.
Okay, let's just get back to some of the areas of the stock market that are influenced by interest rate changes, since we are going to be talking about Jerome Powell, the head of the Fed, and you're going to be watching that later today. What are you seeing with some of the interest rate sensitive stocks in the U.S., utilities, real estate, etc.?
Yeah, they've actually done reasonably well here as interest rates have come down, certainly on the long end. The short end obviously influenced by the Fed and picked up. The long end has come down. We're up at around 305, 310 on the 10-year, down to 285 or so. So that move, I think, has pushed investors back to the more interest rate sensitive parts of the market, utilities, consumer staples, even healthcare, REITs. And they've done well, and that may also be part of this change over the next maybe 6 months to a year to a little bit more defensive market. A lot of those names have come down in valuations over the last 2-3 years as interest rates have gone up. and I think provide a little bit more value in today's market than they have over the last 2 or 3 years.
Paul, good to get your take as always. Thanks so much.
Thank you.
Paul Notle with Kingsview Asset Management joining us this morning from Chicago.